Hello, in this video we will be looking at accounting process. So accounting process is basically how a transaction is recorded in the accounts. So once a transaction happens, we will first record it in the journal or the books of primary entry. So once it's recorded in the journal, we will classify it into the ledger based on the respective headings. And once it's posted in the ledger, we will use the different balances in the ledger accounts to form the trial balance. The trial balance is usually made to check the arithmetical accuracy of our balances. And once our trial balance tallies, using our trial balance we will prepare the financial statements. So the financial statements is split into three parts. We have our trading account, profit and loss account and balance sheet. And it is these three accounts or statements that will be released to the public for our final communication.
I will explain the journal entries. A journal is a chronological order of all the transactions taking place in the organization, and the journal entry is the process of recording all the transactions into the journal. According to the dual aspect concept, every transaction has two aspects, the receiving aspect and the giving aspect. While recording the journal entry, we record the debit and the credit aspect of every transaction. We will now look into the format of the journal entry. We have the date, which defines the date on which the transaction takes place, the particulars in the transaction column, the ledger folio column, which indicates the ledger folio where the entry will be posted, the debit column and the credit column. These transactions are similar to the accounting equations transaction. On the 1st of January 2018, the business is being commenced with cash. Therefore, the cash balance is going to increase, which is the asset account being increased. Therefore, we debit the cash account. The capital will increase, and when equity increases, we credit the capital account. Therefore, cash account debited to capital account is our journal entry. We now have the narration. The narration here is being commencement of business. The narration gives a small or a brief description of the transaction. The second transaction, which is on the 2nd of January 2018, says the goods are being purchased from Kumar. Since the goods are being purchased, the inventory level is going to increase and thereby the asset account is going to increase. Here we debit the purchases account. When goods are being purchased or when the inventory account is going to increase, it always goes through the purchases account. We are purchasing goods on credit. Therefore, the creditor account is going to increase. When liabilities increase, we credit the account. Our journal entry here would be purchases account debited to Kumar's account. The narration being goods purchased from Kumar. The third entry here is on 3rd of January 2018. The goods worth rupees 5,000 are being sold for rupees 7,000. The cash balance is going to increase by 7,000. Therefore, the asset account is going to increase by 7,000 and we debit the cash account. The sales account will always be recorded at the selling price of the goods. And here the selling price of the goods is 7,000 rupees. Therefore, we credit the sales account by 7,000 rupees. We have the narration as being goods worth rupees 5,000 sold for rupees 7,000. The fourth transaction takes place on 4th of January 2018. 4,000 is being paid to Kumar. As the liability, that is creditor's account, is reducing, we debit the creditor's account of Kumar's account. Here, Kumar's account is debited by 4,000 rupees. As the cash balance reduces by 4,000 rupees, that is, the asset account is being reduced by 4,000, Therefore, we credit the cash account by 4,000. The narration being paid to Kumar. The fifth transaction takes place on the 5th of January 2018. The transaction is salary paid and salary outstanding. Salary paid is rupees 2,000 while salary outstanding is 1,000 rupees. Since salary is an expense and expenses are increasing, we debit the salary account. The cash balance is going to decrease, because of which the asset is going to decrease, and we credit the cash account by 2,000 rupees, which is the amount of salary being paid. To salary outstanding. Salary outstanding account is a liability account, and when liability increases, we credit the liability account, and here we credit the salary outstanding account. The salary account of 3,000 includes the salary being paid, which is 2,000, and the salary outstanding amount, which is 1,000, because expenses which are due to be paid will be recorded in the current period according to the accrual concept. Then we see the narration being salary paid and salary outstanding. The sixth transaction takes place on 6th of January 2018. The transaction is goods are being returned to Kumar. Since the goods are being returned, the inventory level decreases and therefore the assets decreases. When the assets decrease, we credit the account. Therefore, the purchase returns account will be credited. Kumar is a creditor. While the liability decreases, we debit the liability account, and here we debit the creditor's account or Kumar's account by 1,000 rupees. We have the narration being goods returned to Kumar.
Since the transactions in the journal entry were recorded in a chronological order, it will be difficult for us to assess in the end of the year how much our purchase was or how much cash we spent during the year. So for that purpose, we use the ledger. So the ledger is the second step in the accounting process, and the ledger book is used for classifying all the entries relating to one heading. So when it comes to a ledger like a cash book, we will record all the transactions that relate to the cash book in the ledger. So let's look at the format of the ledger. So your ledger is divided into two halves. The left hand side is called the debit side and the right hand side is called the credit side. So the format of the ledger looks like this, starting with your date, then you have particulars, journal folio and amount, and the same repeats on the credit side. Now here again we use the same rules as in the elements, whether debit increase or credit increase. Based on each element, we will record it accordingly in either side of the ledger. So now let's look at certain ledgers and see how we record the transactions in them. Now continuing from the journal entries that we already did, we'll look at the first account, that is a cash account. So we know the cash account is an asset account. So the rule for asset is debit when it increases and credit when it decreases. So we will need to go through each and every transaction and first identify whether it affects our cash. And then we need to identify whether our cash is increasing in the particular transaction or whether our cash is decreasing in the particular transaction, and record it in the ledger accordingly. One thing to note is whenever we record a transaction on the debit side, we need to start off by writing to, and whenever we record a transaction in the credit side, we will first mention by. So by going through the transaction, first of all we can see we started the business with cash. So when we're starting the business, the cash is coming into the company, so the cash value is increasing. Since the rule says debit when increase, we will record it on the debit side with the date, to capital and the amount. Respectively, when we look at the second transaction, we make a cash sales. So when we make a sales, cash is coming into the business. So again, as cash is increasing, we will record it on the debit side. We start off with the date, to sales and then the amount. And then if you look at our fourth entry, we are actually paying Mr. Kumar. So when we are paying Mr. Kumar, cash is going out of the business. So when it's going out, the rule is credit when it decreases. So we will record it on the credit side. Again with the date, we will mention by Kumar's account and the amount. Then we are also paying salary. So here you need to notice a part of the salary is outstanding, but only a part is paid in cash. We will be only focusing what is paid in cash because that's the amount of decrease in the cash account. So just like the previous one, since the cash amount is decreasing, we will record it in the credit side. So again, we will just mention the date by salary and we will record only 2000 because only 2000 is paid in cash. And once we've recorded all the entries in a ledger account, in the end of the month, we need to balance the account. So the balancing process is a very important step in every ledger. So how you balance it is, first you need to total both the sides. So when you total both the sides, you need to identify the side with the larger total. So in this side, when we total it, we will get 1,07,000. But on this side, when we total only the transactions, we will get 6,000. So we will take the greater total to be the total on both the sides. So we will write the total within two lines as 1,07,000 and 1,07,000. So now the difference between the total of the greater side and the total of the lesser side will be our balancing figure. So as we have 1,07,000 on this side and 6,000 on this side, when we subtract both, we will get 1,01,000 on the lesser side. So we will record the balancing figure on the lesser side as 1,01,000 and we will record it as by balance carried down. And then once we do that, both our debit side and our credit side should be equal to each other. And then in the start of the next month, we will bring down the balance as on the opposite side. We will write it as to balance brought down and the same amount. So this is how we record it in the cash ledger. So let's look at the next account, the capital account. So as we remember in the elements, the rule for the capital account is credit when it increases and debit when it decreases. So when we started off the business, we started by bringing in cash. So the value of capital increased. So we will post it on the credit side. We will record the date and we will mention by cash account and we will record the entry. As in capital account, there is only one transaction, we can go ahead and balance the transaction. And since there is an amount only in one side, that will be the total for both the sides, and we can record the same value as the balancing figure as to balance carried down. And just like I mentioned in the previous account, we will have to bring that down on the opposite side in the starting of the next month. So the same way, let's look at the sales account. So sales is an income for us, and the rule for income is again credit when it increases and debit when it decreases. So in the transaction, we made a credit, say cash sales, and therefore the value of the sales increased in the company. So we will record it on the credit side. So we will record it on we will record the date and we will write by cash account and 7,000. And just like the previous account, since there's only one transaction, we can go ahead and balance it. That 7,000 will be the total for both the sides as well as the balancing figure. Remember, the balancing figure, the first date will be in the end of the month and we will write to balance carried down, and then we will have to bring this balance down to the next in the starting of the next month, and we will write by balance brought down or B/D 7,000. So now let's look at the next account, the purchase account. So the purchase account is an expense for us. So as the rule says, we will debit when it increases and credit when it decreases. So if in the transaction, we have made one purchase to Mr. Kumar. So when we make a purchase, the value increases. So we will record it on the debit side. So we will record it on the debit side on the respective date to Kumar's account and 10,000. And since there's only one purchase transaction, we can go ahead and balance the account like we did in the previous ledgers. So the next account is the purchase return. So when we make a purchase return, the value of our expense is going down. So we will need to show it on the credit side. So we will record it. Again, we have one purchase return, so we will mention the date. And since the expense is decreasing, we will record it on the credit side. We will record it as by Mr. Kumar, by Kumar's account, 1,000. And since we have only one purchase return, we can go ahead and balance it like we did in the previous ledgers. So let's move to our next ledger account, that is our salary account. And we also know our salary account is another expense account. So we will debit when it increases and credit when it decreases. So when it comes to salary, we have paid salary, but there are two parts to it. We've paid in cash, and there's also salary outstanding. Both of that will have to be recorded separately in the ledger account. So we will first record it. It will both be recorded on the same date. For the salary paid to cash, we will record as to cash account, and we will record 2000. And for the salary outstanding, we will mention it as to salary outstanding and the 1000 rupees. So once we've recorded that, we again have only one transaction regarding salary. So we can go ahead and balance the account. Now when it comes to salary outstanding account, salary outstanding is a liability because we are still yet to pay the salary. So as the rule says, for liabilities, it's credit when it increases and debit when it decreases. So when we look at the ledger, we have a salary outstanding of 2000 rupees. So the liabilities increase. So we will record it on the credit side, and we will mention the date by salary account, and we will mention the 1000 rupees. And just like before, since there's only one salary account, one transaction in the salary outstanding account, we can go ahead and balance the account. And finally, we have Kumar's account. So Kumar is a creditor. Since we need to pay Mr. Kumar money, it's a liability for the company. And so as the rule says, for liabilities, you will credit when it increases and debit when it decreases. So it started off with us purchasing goods from Mr. Kumar. So when we purchase goods, we need to pay Mr. Kumar, so the liability increases. So it will be recorded on the credit side with the date, by purchase account and the amount. Then on 4th January, we paid Mr. Kumar with cash. So when we pay Mr. Kumar, the value of our liability decreases. So because it decreases, we recorded it on the debit side. Again, we will record it with the date, to cash account and 4000. Later on the 6th of January, we return goods to Mr. Kumar. So when we return goods, the value we need to pay Mr. Kumar reduces, so our liability decreases, and we will record it on the debit side. So we will record it with the date, to purchase return and 1000 rupees. So just like all the other ledger accounts we did, we need to balance this account once we've recorded all the transactions. So when we balance, we will see 10,000 is the greater side. We will write 10,000 as the total on both the sides. And when we subtract the greater side with the lesser side, we will get the balancing figure as 5,000. And this 5,000 will be recorded as to balance carried down, and it will be written down to the next month as 1st February 2018 as balance brought down rupees 5,000.
I will explain the trial balance. Trial balance is a statement where all the ledger balances of all the accounts, whether revenue accounts or capital accounts, will be recorded. The trial balance has two columns, the debit column and the credit column. If the transactions have been recorded methodically and later posted systematically, the total balance of the debit and the credit columns will be similar. Therefore, trial balance determines the accuracy of the accounts prepared. This is the format of the trial balance. We have the particulars column, the ledger folio, which indicates the ledger number where the entry is posted, the debit column and the credit column. All assets, expenses and drawing accounts will be written in the debit column, while all capital accounts, liability accounts and income accounts will be recorded in the credit column. Here we have the capital account. Capital account will be recorded in the credit column, so we record 1 lakh in the credit column. Cash account. Cash account is an asset account. Therefore, we record this in the debit column. So cash account is equal to 1 lakh 1000 in the debit column. Sales account. Sales account is an income account. Therefore, we record this in the credit column. Purchases account. Purchases account is treated as an expense account. Therefore, we record it in the debit column. Kumar account or the creditor's account is recorded in the credit column because it is a liability account. Salary account is an expense account. Therefore, we record it in the debit column. The salary outstanding account is a liability account. Hence, we record it in the credit column. The purchase returns account is a reduction in the expenses. Therefore, we record it in the credit column. So, purchase returns account is equal to 1000, which is recorded in the credit column. Hence, we get the total of 1,14,000 in the debit as well as the credit columns. Here we come to the conclusion of the journal entries, the ledger accounts and the trial balance.